Hello, I am your host, Mike Gelb, and welcome to the Consumer VC, where we're going to be diving into the world of venture capital and consumer-facing startups. Our guest today is Eamonn Carey, Managing Director of Techstars London. Techstars is a global seed accelerator and worldwide network that has helped entrepreneurs succeed and is currently in over 150 countries worldwide. Some of their alumni include ClassPass, PillPack, and Contently. He was previously Managing Director at Techstars Connection in partnership with AB InBev in New York, and has been a long-term mentor, advisor, and angel investor in Europe, the Middle East, Asia, and the US. In this episode, we discuss London's startup ecosystem, Eamonn's due diligence process, and consumer trends that he is seeing in Europe and Asia. I had a blast chatting with Eamonn and learned so much. So without further ado, here's Eamonn. Eamonn, thank you so much for coming onto the show. How are you?
An absolute pleasure to be here, Mike. Thanks very much. I'm pretty good. I'm pretty good. Excited to have this conversation.
I really appreciate you taking the time. What attracted you to startups, entrepreneurship, and then move to the other side of the table and become an investor?
So I was really lucky in that I had very patient parents, but also my dad used me as an excuse to buy stuff that he kind of wanted. And so when I was about, I think 7 or 8, he said, "Oh, actually having a computer would be helpful for math and various different things for Eamonn in school." And so he bought this Sinclair Spectrum computer with 48K of raw power, and that was what I learned how to write code on. Back then, you could buy magazines, like this is the mid 1980s. So you could buy these magazines with the code in them, and you would effectively type it out, copy it out, execute it, and play games. And I learned kind of if you change bits of the code, it would change colors on the screen, or it would change the speed of the aliens coming down and Space Invaders or whatever else. And so was always really into computers, continued that through kind of Ataris and Amigas and PCs and into the internet era, and was always spending a ton of time online, on IRC, on all of these kind of different places as I grew up. And so had this real passion for what was happening online. I then went and studied journalism in college and became a journalist, and was kind of looking at what was happening in the media industry and looking at what was happening with the way that people were consuming content and engaging with different things, and was starting to think a little bit more about how I could get more involved in that. And I had a bunch of friends who were working for big ad agencies and PR agencies and brands, and they were all saying, "Hey, this internet thing is interesting. We need to, put more money into it." This was kind of like 99, 98, 99, 2000 and 2001 and beyond. And so started thinking kind of different business ideas. And I vividly remember it. I was in Korea, I think in 2003 or 2004, sitting on a subway, going to meet a couple of friends of mine who were teaching out there. And I saw this guy sat next to me. And this was back when I had a Nokia phone where you had to kind of tap it 1,000 times to send a message. This guy takes out this little black rectangle and starts watching a Spider-Man movie on it. And it was like a kind of, mind explosion of, holy shit, like this is going to be the default way that people are going to consume everything. Like, imagine having a, computer in your pocket all the time. And so started digging into mobile a bit more, and, found some really interesting opportunities, started talking again to those friends who were working for brands. And at a certain point thought, okay, well, I'm going to quit and go and do stuff on the internet. And this is obviously post the initial crash in kind of 2000, 2001. So we started the company in, I think, 2000, back into 4, start of 5. And just started doing stuff with big brands, like building, doing everything from podcasts and mobile video to strategy to J2ME mobile games, all of these different things. But it was that real passion for what was happening online. I think a real passion for the technology and the kind of enabling layer that mobile was, and then that understanding of content. And so was lucky enough to kind of travel the world and grow that company and work with some great people. And that, I think, and then subsequently started a games company with some friends and kind of had a good time doing that as well. And so the experiences and the successes that we had with those 2 businesses, as well as the extreme failure that I had with a third education business, I think that gave me a lot of empathy and understanding for what that founder journey is like. And so as I was kind of thinking about what to do next and starting to kind of, maybe do some angel investing and starting to look at different companies and different opportunities in kind of 2014, angel investing to me seemed like something really interesting to do. And it was a great way to work with founders, to work with people who were smarter than I was, who had better ideas than the ones that I was having at the time, and hopefully give them, some of the experiences that I'd had, and kind of tell them some of the mistakes that I made along the way. And when I first met the folks from Techstars, when they came to Europe at the back end of 2012 or the start of 2013, that whole kind of mentorship driven approach that they had, and that kind of give first model that they had, and motto that they had, was something that really resonated, because I can still remember the people that sat with me for 10 or 15 minutes in 2005 going, hey, let's have a cup of coffee, don't sign this contract, or you don't want to hire someone in this way, or you need to know what a vesting schedule is. People who really gave me advice that made a huge difference. And the ability to be able to give some of that back was something that was really important for me, and continues to be important for me as I invest in companies and join boards, and try and help them through some of the mistakes, so that they can go and make a whole bunch of new mistakes and then come back and tell me, and then hopefully I can put that into action for another generation of companies.
I'd imagine that as a founder, you had lots of learnings. What were some examples of that empathy for founders on the other side as an investor?
Yeah, I think it's understanding that there is, in a lot of founders' brains, this kind of linear path that they go on, where it's like, success begets success, and you raise money and you go, and everything is it's not necessarily easy street, but it's also kind of an understandable process that companies go through. And the reality is, obviously, it's kind of anything but that. And so being able to sit with them and go, look, I can't remember who said it years ago, that every entrepreneur exists in a state of either total ecstasy or total despair, and there's very rarely kind of a middle ground. I think being able to sit with them and go, look, for a lot of founders, actually, what they need to hear is this is actually normal. It is normal to be stressed out. It is normal. I mean, I can probably draw you a map of the ceiling in my house from when I was running a company, because you'd be lying awake at night sometimes going, am I going to make payroll? Like, have we messed things up with this contract? Is this money going to come through? Is this person going to, stiff us on money? All of these kind of different things that you worry about. And so being able to sit with founders and talk them through those processes, and kind of talk them through some of the steps that I took, or some of the conversations I had. And also, I think, to be able to talk to them about the importance of being open and honest, which is, it's not always an easy thing for a founder to do with an investor, because sometimes they're thinking about, well, is this going to affect my next round of funding, or, the follow-on check, or the bridge round this person might do. But, as I say to companies all the time, I can't help with 100% of the things that I don't know about. And the more that I know that things are not going well, the more that I can at least have a conversation, or, try to get involved, try to help out. And I think, that's the other big thing that I try and talk to companies about, is the importance of having these conversations. Maybe not even, and it's sometimes why having a co-founder is really helpful, that you can have, frank conversations about what's happening within your business, whether it be with your board, whether it be with your mentors, with your advisors, or with, some members of your team. But I think that openness and transparency is really important. And also, I think one of the really nice things about the network that we have at Techstars, both just the 10 companies that go through each program, but also the wider community of now close to 2,000 companies that we've invested in, is that there's thousands of founders who are in our network who are going through the same thing, or who have gone through the same thing, and being able to go, oh yeah, it's not that I'm a bad CEO, or it's not that I'm making poor decisions. It's just, this happens. And sometimes there's bumps in the road before there's smooth sailing, or sometimes there's a lot of bumps in the road before you get there. And I think those conversations are really important for people to have, and really important for us as investors to facilitate, particularly, at a very early stage, where every decision that a company makes, or that a founding team makes, feels pretty existential. And one misstep can be the difference between, a spectacular success and something very, very different.
I think it's also important, as you highlighted, as an investor, being very clear with founders in terms of what your actual strengths and weaknesses are as an investor.
Yeah, like I'm good at the 0 to 1 bit, right? The first the first 2 years probably of a company's life, I can help with lots of things, and I'm, hopefully at least reasonably useful. But when companies get to the stage that they're doing C, D, E growth rounds, prepping for IPO, like, I will absolutely be standing on the sidelines cheering them on, and I'm happy to go for breakfast, lunch, dinner, drinks with the founders and have conversations. But there are people who are far smarter and far more versed in those sections of a company's life cycle than I am. And I think it's been interesting to watch that evolve over time, and to watch companies realize that that's not just true for your investors and your board members and your advisors, it's also true that, there are some people, who are execs who are good for the kind of 0 to 1 bit, and there are a bunch of other people who are good for the kind of 1 to n bit. And so I think understanding that and being honest and being able to say to companies at a certain point, hey, you probably don't need me on your board anymore. You need someone who understands, these processes is a healthy thing for us and a healthy thing for companies.
Absolutely. Let's talk about that 0 to 1 bit. In your due diligence process, by assessing at Techstars and assessing startups and what to invest in for your next cohorts, what types of qualities do you look for in founders? Because at the 0 to 1 stage, there's not a ton of data to go on.
Yeah, I think, we kind of boil things down to a pretty simple way of thinking about things. When we're looking at companies from a Techstars perspective, we always say to people, we look for 6 things, and it's team, market, traction, idea. And so for me, like the who and the why behind a business is frequently far more interesting at the stage that we're getting in at than the what that they're actually building. I think Jay mentioned it on a previous podcast. A bunch of companies that go through Techstars programs will finish the program doing something either slightly or radically different to what they started doing the program with. And so, that focus on team and resilience and passion and coachability and, the ability to kind of digest large volumes of information from the 100+ mentors that they'll meet in month 1 of the program is incredibly important. I think you want, people who've got real passion for what they're doing. Like if I look at the consumer investments that I've made over the years, a bunch of the founders, in my view, would be effectively the personification of the brand that they're building. And they live and breathe that brand in a whole bunch of different ways. And when you meet people like that, you can actually, in many cases, almost feel the energy or almost see the energy fizzing off them. And that, excitement and passion is something that gets me really excited, because then I start going, oh, okay, actually, with the right structure and the right people and the right supporters around this person, they can literally kind of, create magic. So I think that, as we kind of think about companies, is probably the most important thing. And then, of course, you want to, be investing in markets that are maybe small but growing, where there's some unique advantage that the company has, or a big market that's ripe for disruption, or a market where there's, a lot of incumbents that you want to come in and kind of pull the rug out from under. And obviously then kind of there needs to be some degree of momentum. I think what we're really good at doing is taking companies where they're already accelerating and the kind of foot is already on the gas, and kind of being able to add to that and help them get even further along and help them do more faster. And so looking for companies, and that doesn't necessarily have to be that they're doing hundreds or thousands or tens of thousands in sales or revenue, or have hundreds of thousands of users if they're a consumer app. But it does mean that they need to be able to show me that something is happening. And I love getting investor updates from companies every week or every month, where you're just seeing, even without maybe access to capital or access to a network or access to the support that they'll get on a Techstars program or from other investors. I love to see that there's something happening and that there's some momentum, because that then you kind of go, okay, we can help with this. And then frequently the kind of, as I say, the idea is almost the least important thing in some cases, because if you've got the right people and the right support network around them, if you can kind of guide them through maybe 1 or 2 pivots, or help them kind of understand that a very small change to the business or business model, might make a very material difference. Once you have those things in place, it helps. And I think as you get further along, of course, you can look at, NPS and retention rates and engagement rates and all of these kind of different things. But I think for me, fundamentally, it's the stage that we're investing in, it's a people business. And so making sure that we're backing the right people and making sure that the 10 companies in the batch that are going through together are going to be the right mix of people to be able to support one another as well, I think is hugely important. And then the other big thing that I kind of look for is, what's the insight, or what's the customer understanding, or what's the kind of unique attribute that this founder or this team has that's going to allow them to, potentially build a wedge into the market that they're going after. And I love finding companies that are kind of solving problems that they really faced themselves, and that's where that kind of passion and engagement and interest comes from.
You kept repeating, the company has to be showing that something's happening, right? I just wanted to know what you think about product market fit when it comes to consumer. I had another investor said that that in terms of consumer, you kind of know it when you see it. It's a hard thing to explain. Is that so? Finding like product market fit, is that just the thing about in terms of like your gut reaction, or I know that consumers are a very broad category area, but what are maybe some metrics that you might be thinking about to see if this is something real?
Well, I look for so part of it is gut, which is probably not the necessarily always the best way to invest, and part of it is pattern recognition, having kind of looked at companies in similar sectors and spaces before. I think in the absence of kind of hard metrics that you can look at, and like those NPS scores or like those retention rates over a 6 or 9 or 12 month period, I look for things like customer love. And so I give you an example. We invested in a couple of companies this year where throughout the entire process, as they were talking to me, the updates that I was getting was showing me, emails and messages and stuff that they were getting from their consumers via their help desk. And then if I would look them up on, Twitter or Instagram or anywhere else, like the outpouring of support and engagement and everything else is huge, right? And so we invested in a company called On, which is a company that kind of reshapes how women experience their menstrual cycle. And so they give them access to organic period products, CBD oil, all sorts of different things like that. And if you look at the love that they were getting back from the community that they had already built, you could see real passion and real engagement with the product. And they were seeing kind of 60-70% of their user growth was coming from word of mouth and people telling their friends and telling their friends, et cetera, et cetera. And so when you start looking at that, that is, even if the company only has hundreds or early thousands of subscribers or customers, that's something that you can really tangibly see. The same was true when I looked at the guys from Kenko last year, which is kind of making fruit and vegetables more accessible to consumers. So they have these powdered smoothie mixes that you mix in with water or milk and shake them up and have a juice or a smoothie or a milkshake. And again, when we were talking to them about 18 months ago now, you could see the number of people posting about the product on Instagram, the number of people that were saying that this changed their lives. It was incredible. And when you see that organic growth, when you see that real outpouring of love from customers, and you think, okay, if we could, as I said earlier, like kind of wrap a little bit of a layer of support around this and wrap the right people around this, you can kind of take that to a much bigger audience and look at ways of kind of replicating that to thousands, tens of thousands, or millions of consumers. So I think those are, things that you can look at in a relatively tangible way, without necessarily having to kind of look at whatever Google Analytics or anything a little bit more hardcore, that I think starts to kick in more when you're at that full product market fit stage and you think, okay, now the application of some paid media or distribution channels or partnerships might help us really kind of accelerate growth. But I think in the early stages, you need to look for that, hundreds or thousands of customers who are absolutely in love with the product and who are absolutely in love with the team that have brought that product to life. And I think in many of the cases and companies that I've been lucky enough to invest in, that's been the case. And that's been really tangible as we've dug into them a little bit. Let's say you've got 11,000 or 10,000 followers on Instagram and, 2,000 of them are liking every post that a company puts out. Like that's a pretty material gaming of the algorithm. And again, it just shows how often people, it is by no means a scientific measure. Like no one is ever going to put it in an algorithm and win a Nobel Prize for it. But you're looking for all of these little micro signals to support a little bit of what your gut is telling you.
Right. What's different and exciting to you about London's ecosystem, maybe compared to the Bay Area in New York, since a lot of the investors that we've had on the show are from live in the Bay Area or New York City?
Yeah, I mean, I think, look, I really miss living in New York. I spent a wonderful time over there running the Techstars Connection program with AD InBev and loved every minute of it. And there's a real dynamism in the city and a pace of deal making that is kind of unrivaled anywhere else in the world. But I think there's something quite unique about London, in that I think if you look at concentration of capital and fundraising, certainly in the kind of Western world, it's probably San Francisco, New York, and then I think London is probably in certainly third or fourth place in terms of the volume of capital being invested into early stage and mid stage kind of tech companies. So there's lots and lots of capital here, and not just European capital, but increasingly US funds are starting to invest in companies here, both at kind of pre-seed, seed, and Series A. In fact, Kenko, who I mentioned earlier, Next View Ventures and Max and a couple of others invested in their round. Banjo Robinson, who went through the most recent Techstars London program, had Collaborative Fund and Sesame Street's venture arm invest in their round. So we're seeing activity coming in from the US, and we're seeing capital coming in from China, Japan, and other markets. So lots and lots of access to capital across all of the different stages. There's access to talent. Some of the best universities in the world, in the greater London area, but also even as you go out into Manchester, Edinburgh, even across the water into Ireland, into Dublin, there's some incredible talent coming out across biotech, machine learning, computer vision, lots and lots of different areas, and I think the university and tech transfer ecosystem has gotten a lot stronger. And then I think one of the other big things is, if you think companies need capital, talent, and kind of partners or clients, in the oil and gas industry, you can go and meet BP and Shell, and 20 minutes later you can go to the heart of the financial and insurance industry and meet every bank and insurance company you want to, and then get on a tube and 20 minutes later be at the heart of the kind of European, Middle East, and to a certain extent even part of the Asian marketing and advertising industry. And so if you look at all of these big categories, whether it be automotive or CPG or advertising or insurance or finance or oil and gas or energy or any of these other things, a lot of very large companies and corporates have substantial presences, headquarters, and operations here. And so, I think it's relatively unique in the ability to access all of these very senior decision makers across a range of industries in a way that we haven't, you don't necessarily see in a lot of other cities. So some cities are obviously a lot better at some things than others. But I think London, in terms of just density and proximity of people and industries, is quite unique, and I think that kind of creates its own gravity and its own excitement. And I think then allied to that is there are now companies like TransferWise and Revolut and Monzo and many others that are at that kind of whatever unicorn status. We've had kind of DeepMind and Darktrace and lots of other companies in the AI world that have gone on to become hugely successful. And so I think there are role models here now, and there are kind of mentors and advisors and angel investors in the community who have come out of those companies and are starting to kind of reinvest into the ecosystem, which I think is kind of what this part of the world has been lacking for a long time. And so you kind of take all of those elements and put them together, and you kind of go, well, actually there's a little bit of a secret sauce here. And then you add that to the fact that it takes 6 hours to get to New York from here, which is kind of the same as from San Francisco to New York. 3 hours in to the east, you can be in pretty much any capital city in Europe and touch a little bit of North Africa. If you're willing to go 6 hours to the east, then you're covering Turkey and a big chunk of the Middle East. So you're talking about a substantial portion of global GDP being within a 6 hour flight of this city. So that again kind of just adds a little bit to the allure of the city, or at least that's my tourist advertisement for it at a minimum.
I appreciate the commercial. I wanted to talk a little bit about Brexit. Has this changed how you think about investing at all?
There was a really funny cartoon that was doing the rounds on Twitter the other day, where it was kind of, the British, it's 2192. The British Prime Minister has come to Brussels to ask for a symbolic extension to Brexit. No one even knows why he's doing this or where the tradition comes from, and yet it persists. I think the Brexit thing is I mean, it's frustrating in that it has been dragged out for quite a long time with very little clear picture in terms of where we're going to go. Maybe this election on December 12th is going to get us somewhat closer to an answer. And certainly when it happened, when the result of the vote was announced, I did kind of have slightly gloomier thoughts about the prospects for not just the technology industry, but the wider economy. But the reality is, actually, it seems to have not made as big an impact as anyone thought it would. I mean, there was certainly a lot of talk of all of these banks and big companies and everyone else is going to move out of London. They're all going to be in Frankfurt or Paris or Dublin, et cetera, et cetera, et cetera. And that hasn't really happened. I mean, obviously some jobs have moved, some jobs will continue to move, but that's kind of the nature of business. If anything, we've seen more new funds come to market since the Brexit vote was announced, and even ones that started raising for seed funds, Series A funds, and growth funds way after the vote was announced. So it hasn't made a huge difference. And I think the other big thing that we've seen happen is, as investors and as companies, frankly, have gotten more comfortable with remote working, the kind of talent challenge that everyone assumed that we would have of, oh, maybe we won't be able to attract people to move to London because visas might be a little bit more difficult for folks to get. Actually, the solution to that has been remote working. And so if I look at, companies like Let's Enhance that I invested in last year, they have a sales operation. The CEO is based here and sometimes in San Francisco. And then their, machine learning research engineering team, everyone else is based in Kiev. And so it's a, 2.5 hour flight for them to go between. They're roughly in the same time zone. So communication on Slack and Skype and Zoom and everything else is pretty straightforward. So I think it has had a far lesser impact than I was concerned that it would have pretty early on. And certainly there has been no slowdown in the pace of investment into companies. Like, great companies are still getting capital. And as I said, money from the US, money from Asia, money from lots of different places are still seeking out great businesses here.
I'm glad you brought up remote working. How do you think about remote working at the very early stages? If a company were to be accepted into, or you were conducting your due diligence in a company that maybe the founding team or was all remote, how would you feel about that?
I think a lot of that, the kind of due diligence process for that company would probably be a lot more about almost looking at their calendar and the structure of how they communicate and how they kind of keep in touch with one another. Like, I'm pretty comfortable with the idea of remote working, so long as people have some systematic processes or structures in place that allow them to actually understand what everyone else in the team is doing. I mean, I think where I've seen remote working not work for companies in the past is where everyone feels like they're kind of paddling their own canoe, and frequently they're all paddling them in different directions, and it's a bit higgledy-piggledy, and it leads to frustration and annoyance and grievances and all of these other things. Whereas I think if you sit with a company and they go, oh, okay, actually, we have these stand-ups organized and we're using these Gantt charts, or we're using Product Plan, or we're using Asana, or we're using Trello, or Notion, or whatever the tool is to kind of, so that everyone understands what's going on everywhere else. I think that is a huge part of the solution. I think then if you look at, some of the companies that we have invested in where the team is maybe not fully remote, but largely remote, they do a pretty good job of either, quarterly or more often, depending on how much money they have in the bank or how remote they are, of trying to get everyone together so that there is this feeling that you're not just this kind of amorphous blob of community that exists on Slack, but actually, 5, 10, 20, 50 real people who all work for the same company. And so I think you have to be very systematic about how you manage that communications process and manage, both internal and external communications as a remote team. And that is something that I would dig in on. But, we've had it work in the most extreme circumstances. We had a company called 42 Maru who did the program last year where, the CEO, their chief strategy officer, and briefly their CTO were in London. They had another 30 engineers working in Seoul, South Korea, with a fairly substantial time gap in between the two, and some other people working elsewhere. And so, they were able to manage that process, with a lot of very early morning and occasionally late night telephone calls. But because they had those systems and structures in place, they could do it. And so I think if I look at companies where the geographical distance isn't so vast, it is solvable. I mean, even Kenko, who I mentioned earlier, their production, ops, everything else happens in Lisbon. One of the co-founders is based between Lisbon, London, and New York, as indeed is the other, actually. And so, they're spread out around the world, and the company still runs like clockwork because I think they have those processes in place. And, even Techstars is pretty distributed. I mean, I think we did the numbers at our last all hands is like, close to 300 people working in nearly 40 countries around the world. So we kind of, it would be a bit rich if I said, oh no, we can't do remote companies, when, someone could look at it and go, well, you have staff in Finland and Estonia and the UK and Ireland and, Colombia and all of these kind of different places. So I think it's doable, but it certainly adds a little bit of tension and friction potentially, but it's a solvable problem.
Do you think that remote working is maybe more common amongst maybe European founded companies just because you have these different smaller countries as compared to the US, which is just one, giant large country?
Yeah, I think it's probably a little bit more common. Although even if I talk to some of my colleagues in the US, you can start to see people going, well, if I'm building a company, do I have to have my entire engineering team in the Bay Area, or do I have to have my entire sales team in New York? Because it becomes pretty pricey and pretty competitive very quickly. And that's starting to happen in London, right? You've got Facebook and Google and Amazon and lots and lots of other companies with centers of excellence and engineering hubs here, and they're obviously competing for talent. But also, I think it is because of that time zone or the flight time thing that I mentioned. You can start a company in Dublin, and if you get up at 7 o'clock in the morning, you can be taking your first meeting in London at 10 a.m. If you're in Paris, you can literally take the train from Paris to London to do a meeting. If you're in Berlin, it's a 90-minute flight. If you're in Kiev, it's a 2.5-hour flight. So I think it's quite natural for companies to start elsewhere in Europe to maybe grow in their home market. And then to kind of think about, okay, well, London is maybe the first big international market that you'll kind of earn your spurs in, and then you'll maybe think about the US or another market. So I think that kind of geographical proximity probably makes it a lot easier for companies to do remote working, because realistically, if the time difference is 1 hour or 2 hours, it's negligible enough that you can actually persistently be in touch with people during the day versus maybe greater geographical spreads and greater time differences as well.
Those are all great points. We talked earlier before the show about how you're kind of a globetrotter. Techstars in London, you source deals for Zeroth, which is a Hong Kong accelerator. How do you think about consumer trends globally and in different markets, and how consumer companies are expanding to different markets?
I think it's been interesting to watch it, right? Like, I think there is a greater level of comfort with new consumer brands in the US. I think people are quicker to adopt new brands and to get kind of familiar with them. And I think part of that is actually, if you look at a lot of the big consumer brands in the US, they have been quite fast to do kind of brand advertising rather than just pure direct response kind of paid media stuff. They have been quite good about getting, posters on subways or advertisements on TV or any of these things. So I think there's more comfort with that market in the US. I think it's still it's growing, and I think you're starting to see kind of particularly in the financial sector, companies like Monzo and Revolut have really kind of captured a huge amount of market share as kind of challenger banks and TransferWise and others over the last couple of years. And part of that has been word of mouth. Part of that has been a growing kind of comfort with these new fintech challenger banks and brands that are coming out. And so I think as people get more comfortable with it, you'll start to see, and which is what we are seeing, more and more kind of consumer brands coming through in the European market. I think, when I was in Japan a couple of weeks ago, and if you look there, they're still maybe a little bit. I mean, obviously they have their own indigenous consumer brands that are quite big, but the volume of people actually starting consumer companies or direct-to-consumer subscription companies is obviously it's far smaller than we see in this part of the world. So there's a lot to do with kind of acceptance rates. But then if you look at markets like Indonesia or Bangladesh or Vietnam, you'll see loads and loads of people starting direct-to-consumer brands. You'll see lots and lots of people starting companies in this sector, because a lot of those countries will frankly largely be ignored by bigger players or more heavily funded players in Europe and the US, because they'll be seen as being maybe too small at times or too far away or too difficult from a linguistic perspective. So it's interesting to watch it. We've historically in Europe, companies would maybe they would launch in their home market. Their first big test bed then would be the UK, and then they would look at going straight to the US, or maybe they would just go straight to the US. We're seeing more and more companies going, oh, actually, there are opportunities to the east. We are seeing more investors coming in from China, India, Japan, other markets in Southeast Asia. And now, not every company by any stretch of the imagination, but certainly we're seeing one or two out of every 10 consumer companies that we invest in kind of going, oh, actually, there might be something that we can do a little bit further afield. And certainly from what we've seen And what I've experienced with brands and organizations and partners in the Asian market, there's a huge appetite for companies that want to expand out of the UK and out of the US into those markets, and a huge push that can be done from a partnerships perspective, from an awareness raising perspective, from a user acquisition perspective, and from a localization perspective, obviously as well. So I think the world is kind of full of a bunch of really interesting opportunities at the moment, and that's one of the challenges for companies that exist as well. Is you have this whole smorgasbord of choice, and if you make the wrong step, it can be a pretty big mistake to make. But being able to kind of think about coherently which market you're going to go into, it's probably the first time in a very long time that people have had the luxury of being able to even think like that.
What consumer verticals are you right now focused on or excited about that you think are ripe for expansion in Asian markets that are European companies?
I mean, I think food, there's a, regardless of how we produce it or how we consume it or what we consume, or what we cook it on, or, any of these different things, I think the whole, if you kind of think about the scale of the opportunity, like we all, to a greater or lesser extent, have to eat twice or three times a day. So I think that opportunity is fairly substantial, particularly as you look at kind of, I'm on the board of a company called Click and Grow, which is kind of indoor farming, allowing people to grow vegetables and herbs and more in their home, and getting to a point where they can actually grow a sufficient amount to feed themselves. Companies like that in a lot of Asian markets and in Middle Eastern markets, there are huge opportunities. We've seen the same with Kenko, giving people access to those kind of 5 a day fruit and vegetables, using these kind of powdered mixes where you keep all the dietary fibers and all the nutritional and flavor benefits. There are huge opportunities for those types of companies. I think I'm excited, and I haven't seen as much of it in Europe as I'd like yet, but we will see more. And I think it's something someone mentioned on a previous episode of, I meet a lot of companies building stuff for 16-year-olds who have no money. I meet fewer companies building things for 60-year-olds who do. And so technology for that older population, if you look at Korea and Japan in particular, there is an epidemic of loneliness. There is, there are huge challenges associated with the rapidly aging population. There's like obviously extreme longevity in Japan. People are living comfortably into their 90s and even, past 100 fairly routinely. And the birth rate is at, historic lows. And so there are big challenges in those markets from a health, a wellness, and a longevity and a quality of life perspective. And so I think there are huge opportunities for companies that are tackling those areas. So I think those are kind of two of the sectors that I'm most excited by at the moment. And then I think there's lots of other kind of stuff that's sitting around the fringes where I still think there's people talk about companies or individuals having subscription fatigue. If I look at, there was a famous diagram that someone did a couple of years ago where they looked at Craigslist, and then they looked at all of the companies that kind of came in and took out each little section of, houses for sale or cars for rent, or, the casual encounters was Tinder or whatever. I think if you look at, the kind of big incumbent CPG, category defining companies like Unilever and P&G, you could probably look through their roster and go, hey, there's still a lot of clear blue sky for companies to go into and disrupt and do interesting things with. And so, I'm pretty bullish across the board, actually. And education, I think, is your big one. Sorry, I should have said, I think there's huge opportunities, particularly in the Asian market. There's a real premium placed on education, on language acquisition, on quality of education, etc. That maybe we've don't quite have the same fervor for in this part of the world. So with linguists who have been on the board for a couple of years now, Japan, Taiwan, China, a lot of those markets are pretty substantial and pretty exciting for us, and ones where we see substantial growth and engagement as well.
I think education as well on the West as well, because since traditional education, I feel like is no longer as valued if you look about the cost for traditional education versus the benefit. And of course, lots of disruption has already happened in education.
And lots more to come, right? I mean, if you think about it, it's been heavily regulated. It has been slow to adapt and adopt and all of these different things. And, I think there's now a bunch of companies coming in around the side. We see a lot of people pitching as kind of tools for teachers that are looking at a kind of bottoms up, almost Slack style approach for adoption. We're seeing lots of people pitching as kind of, machine learning and adaptive algorithms for education and, lots of other areas like that. And so you kind of think that idea of, probably the way that you and I went to school, where it's like one person teaching 20 or 30 kids and assuming that we all learn in the same way and at the same pace, is fundamentally just not the way the world works. And so I'm really excited to think about what, personalized education might look like, and what it might look like if people who are teachers look more like mentors than they do like, the person standing at a whiteboard up the front of the class trying to get everyone to pay attention to the same thing at the same time, which is, can be probably a bit thankless at times.
Agree. So you wrote an article about how raising too much money can kill you. Of course, we're living in these times where capital is really cheap. I wanted to ask you how you think about good growth versus bad growth in a startup, and a little bit into your own diligence process, or rather during the accelerator, maybe as you mentor and are part of these startups' journeys in your cohorts, how you think about growth.
Yeah, I mean, I think, there is a temptation, and you see companies do this all the time, where they'll get into an accelerator program, or they'll raise their pre-seed round on the basis that all of their growth has been organic to date. So they're like, oh, we're growing everyone by using word of mouth. We have this huge amount of customer love and customer loyalty and, all of these things. And now we're going to raise $3 million and we're going to spend 80% of it on Facebook ads. And you kind of go, okay, well, like who's going to, have you segmented your users out into different cohorts? Do you understand kind of where they fit? Do you understand how you're going to target it? Do you understand what the outcomes need to be? Do you understand kind of LTV over CAC, what you need to achieve in order to get to your next round of funding? And in many cases, you kind of get a blank look back. And I think people think, oh, well, if I put 80% of my budget into marketing, I just turn on a user acquisition hose. And then you kind of start going into, well, actually, there's a difference between acquiring quality users, which is, a lot of what you get from referrals and word of mouth, and the very big difference between them and, some of the users that you will bring in if you suddenly just turn on a kind of spray and pray approach on social media. So, or any paid media channel for that point. So I think, like growth is important. I think growth at all costs can be really challenging and detrimental to companies. And so I wrote that post because I was seeing a lot of companies going out and fundraising. They would say, look, we need to raise, I don't know, let's call it $5 million for our, seed extension round or our Series A. And I think, occasionally you will see companies, and this is usually a pretty good thing, fund will go, hey, what would you do if you had 7.5 instead of 5? And if the company has a pretty good answer, go, oh, well, actually we could hire 2 more engineers, we could open an office here, we could do these things, and it would probably give us an extra, 5-6 months of runway and allow us to run a few more experiments. I think that's positive. I think what I saw, and one of the reasons I wrote that post, was I was seeing people going, hey, we want to raise $5 million. And there would be funds going, well, what would you do if you had 12? Or what would you do if you had 20? And the challenge with that is it looks like, from a headline perspective, it's, raising $20 million may, to all intents and purposes, look like more of an achievement than raising 5 or 7.5. The challenge is, again, the headline number of your valuation of, $100 million or, $80, $100 million. If you do that 20 million raise, the challenge is that by the time you get 18 months, and probably not even, by the time you get 12 months down the line, you have to have the numbers to support that valuation. Because if you go out and start talking about a subsequent round of funding, and we can talk about this in a minute, I don't know necessarily that lots and lots of consumer companies need to do, dozens or hundreds of millions of dollars in funding rounds. But, regardless if it's 20 million at 100 or if it's, 5 at 25, when you really only needed 1 million, if you can't get your numbers and your revenue and your projections and, all of the cogs turning in the right way to justify that valuation within 12 to 18 months, then A, it's going to be really difficult for you to raise your next round of funding. B, if you do raise it, it might be flat or a down round. So you're going to end up, being potentially slightly underwater. If you sell the company before you achieve that kind of valuation that was put on the business, then you may find that as founders, you end up with a very, very small chunk of what looks like a lot of money because of the way that liquidation preferences kind of worked out. And so I think there's a huge number of challenges that come with that. And I think, one of the things that I say to companies an awful lot is, look, it is obviously very important to grow a business. There's businesses by their very essence should be things that, grow and scale and make money and become, sustainable and wash their own face and, all of those types of things. However, if you pursue a growth at any cost process, you can just kind of end up shooting yourself in the foot.
Entrepreneurs always need to be thinking about as well what this means and what does it look like for the next round when you're fundraising.
Yeah, and look, there was a great article, I think it was on Hacker Noon a couple of years ago, where they talked about like the economics of VC. And I think for anyone who's thinking about going out and raising a seed round or Series A or Series B or anything else, like understanding what the economics are in terms of what venture funds look like and what return profiles need to look like for venture funds. The math is not necessarily in favor of certainly what we've seen in the consumer market over the last little while. And so I'm much more in favor of consumer companies that can raise a sensible amount of money, can grow, can build great brands, can build great mind share, can build kind of great affinity with their customers and build a real viable brand. And you know what, maybe instead of raising, tens or hundreds of millions of dollars from a more traditional VC route, there's equity crowdfunding. There's lots of interesting stuff going on now that potentially gives them access to different pools of capital that come with very different strings attached to that more traditional VC route.
When do you think a company should optimize for profitability versus optimizing for growth?
It's a little bit like the product market fit thing, right? You kind of know it when you see it. I think there does come a point where you can see over a 6-12 month period real sustainable growth that is pushing you in the direction of a profitable business that is still growing at a reasonable kind of at a reasonable pitch. I think when you start to see that, depending on what you want your outcome to be, that's the point at which you can start going, okay, well, maybe we need to pull a few more levers on the revenue side of things, or maybe we need to look at our cost base, or we need to look at a little bit of margin, or do we need to invest in order to get some additional margin? So I think it's kind of thinking systematically and structurally around kind of when the right time for that is. And again, sweat your board, sweat your advisors, sweat your mentors, ask them what they've seen in previous companies that have gone through this process. I think, with growth, you have to be careful with kind of what growth actually means. I think one of the biggest challenges for consumer companies at the moment is it's not entirely clear what the best distribution channel is anymore. So if you had built a mobile app, 10 years ago, I remember reading an interview with Luis from Duolingo. He was like, yeah, every time we got featured on the App Store, it would be worth about 2 million downloads in a single day. And because they were so popular, they were getting featured, maybe a dozen times a year in the App Store. It's like suddenly 24 million users. We've had companies that have been featured on the App Store recently where you'd be lucky to get 10,000 downloads in a day. And so that as a distribution method is maybe not as productive as it was before. Paid media costs, if you're advertising on Instagram or Facebook or any of these different places, have gone up fairly substantially, and you can't necessarily rely on that as much as you might have in the past. We're seeing a lot of people looking at physical retail. It's exciting to see, Showfields and Beta and all of these kind of places bringing startups to the high street or to shoppers where they are. But I think sometimes you can I see a lot of people optimizing for growth without thinking about exactly how they're going to grow. And the default is to go, we'll spend lots of money on advertising. Actually, sometimes it's better to spend it on bus ads than it is to spend it on, digital ads. And so thinking, coherently about that, if you can, I say to companies all the time when they're thinking about raising ventures, like, if you can give me a really good reason and a really good plan for how you're going to spend this money that you have thought out and thought through and have at least some degree. I'm not looking for a kind of PhD thesis level of peer review, but I am looking for some sort of evidence-based reality behind this kind of ask for X million. And I think you can kind of optimize for growth if you've got all of those ducks in a row. But I think if you're optimizing for growth just so that you can get a kind of nice headline number, and everyone can go and drink a couple of bottles of champagne, that's fine. But you're going to come back in a couple of days later and go, oh, we need to make this a $200 million company in the next 12 months, or everyone is getting laid off or fired, or worse. There has been probably a slightly smaller appetite for consumer investments in Europe than there has been in the US over the last couple of years, although it is changing. We're certainly seeing more funds putting capital into the sector, but it has meant that a lot of companies have to kind of think, okay, I can't necessarily rely on the fact that there will be, money waiting in 18 months, assuming I hit these targets. And so we do see companies think a little bit more about, okay, what do we need to get to make sure that, the unit economics start to stack up in a way that even if this doesn't go exactly according to plan, we can still, either with a small bridge or with, some venture debt or whatever it is, get ourselves to a point where this is a long-term viable business. And so that's been kind of interesting to watch, that discipline that it imposes.
I think those are all absolutely excellent points. What is something that you would change when it came to venture capital?
I wish, and this I will include myself in the kind of desire to change category here. I wish people were more honest. So I think, and this is something I'm working on pretty hard myself, and hopefully will be a lot better at in 2020. Like, as someone who was a founder and who went through the kind of merry-go-round of talking to investors in the past, you do get a lot of like, oh, this is great, and oh, keep us posted, and yeah, we're excited to be involved, and kind of all of the things that investors sometimes say instead of saying no, no, I don't want to invest, or I'm definitely not going to invest, or oh, keep us in touch, like when you get a lead, come back to us, etc. Like, I actually think I think it's we're in a very privileged position to work with really smart people who have great ideas and great energy. And I think sometimes we do them a disservice by just bullshitting them and not saying, hey, I'm not going to invest because actually, all of these numbers look wrong. Your projections are way off. And, what you're thinking about here is probably not right. And what I think you should do is A, B, and C to address it. And I think, I don't mean everyone should be kind of an asshole, but I do think that we could be a lot more constructive in terms of how we deal with companies pitching us. And I really respect, there's a fund here in London called Kindred Capital. And I'm lucky enough to know Russell Buckley, who's one of the partners there. And I've spoken to him about this a bit, where, they will say no to people in the meeting and they will give them some constructive feedback. And they then send out an NPS survey to kind of say to people, hey, how do you feel about the interaction that you had with us? And it's overwhelmingly positive, even from people when, you're effectively saying, no, I'm definitely not going to invest in your business. And I think this, and this aren't right. And, you need to address them. The extent to which people really value that is incredible. And it's something I think we could all stand to be a little bit better at. And of course, no one wants to say no to a deal and then have it turn out that obviously that company turns into like some mega success story. But, that's the peril of the game. I think what I try and do with companies is give them at least a little bit of constructive feedback. And I say even to the companies that I say no to, I'm like, look, you can stick me on your, mentor or investor update. Like, I'm happy, and I read as many of those as I physically can in any given month. And if I see someone who's doing something interesting, I run a deal flow email that goes out to 800 VCs and angels around the world that I started when I came back from the US. Like, I'll ping it out to people there, because I think, having gone through that journey myself and met some people who were super helpful and really nice in terms of the intros that they gave, I think it's kind of incumbent on us to do that. And I think if we could be just a little bit, and not to sound like the VC starter kit, like how can I help, cliche, but I think if we could be, slightly more helpful for companies, I think one big thing that we could do is say, it's a no, here's one or two reasons why it's a no, and maybe it's just a bullet point, and here's one thing that I would do differently. Like, it would literally take 4 or 5 minutes to fill that in. And I think no one is that busy, particularly if you've had, like, fair enough if it's a cold email and or it's something that you haven't had much engagement with, but if you've had a 15-minute meeting with someone, I think you could spend another 5 minutes sending them a note saying, honestly, it's not for me, and here's a reason or two why.
Yeah, I mean, I absolutely agree. I think, VCs don't want to, of course, lose that relationship in case later on they want to invest.
And I'll tell you this, I have a much better relationship in many cases with founders where I've been, and I did it as an experiment this year to kind of go, okay, if I am honest and if I do this, and if I do say no, and here's one or two, reasons why, in some cases people didn't, react particularly well. And I got one or two kind of angry emails back going, oh, well, you're totally wrong, or well, way worse, but not for public consumption on a podcast. But I also got lots of people coming back going, hey, I really appreciate that. Thank you. I hadn't thought about it in that way before. And in many cases, I still get updates from those companies. And I think that's the kind of unintended consequence that comes out of this, that actually, I think if you're intellectually honest with someone and you say no, and here's one or two reasons why, actually kind of what you're doing by doing that is giving them an excuse to get back in touch with you further down the line to go, we've resolved those two issues. We're raising another round. Now is this a fit? So I think I've built a really good relationship with quite a few companies that I've initially said no thank you to them.
It's almost like you saying the reasons why you won't invest, not a challenge per se for the entrepreneur, but it gives them something to think about, and then to be able to solve those problems to come back to you.
It's like the three most powerful words in the English language frequently are "I don't know." So if you're in a pitching competition, or you're in a meeting with an investor and they ask you a question, instead of giving them some kind of bullshit answer or doing the classic thing that founders do of like, I'm going to answer the question I wish you'd asked me rather than the one you actually asked me. If you say, I don't have that information, I don't know the answer to that question, however, can I pop you an email tomorrow to let you know? Or as soon as I get out of this meeting, I'm going to call our CTO and get the answer to that scaling architecture question. It just gives you an opportunity to get back in touch with that person. And I think that's often, often missed by companies. And I think that's, the same with this. I'm saying, here's one or two reasons I might not invest. Gives the founder either, they can come back and say, hey, we've resolved these now, what do you think? Or, just hopefully gives them a useful data point for the future.
Just stay on the subject for a minute. If a VC tells an entrepreneur, we want to invest, but we will not be the lead, how should the entrepreneur respond?
They should do Techstars. So my colleague David Cohen, who's the co-founder of Techstars, does an amazing fundraising workshop with all of the classes, where he talks about these kind of contingent commitments and the challenge of getting people to lead. I think it's one of the most popular things that we do during the entire program. But I think it's trying to understand, like, what does that, I think a lot of what happens in VC land is people are kind of talking in code. And so when someone says we want to invest, but we don't lead, right? Depending on the fund, some funds just don't lead, right? Like they just don't have the capacity to do it, or they don't want the board seats, or they don't want the responsibility or the energy and builds of putting the kind of term sheet together. So some founders get frustrated when they go out and they pitch funds, and then the fund goes, well, I'd like to be involved, but come back to me when you have a lead. And then when they come and they say, oh, firm X is not, they say we have to wait for a lead. It's like, well, that firm never leads. So I think there's a research question that companies need to do. I think there's a conviction question that investors sometimes need to answer. Are they kind of going, okay, well, I kind of like this, and I've done some due diligence, but I'm still not sure, so I'm going to kind of outsource my conviction to another fund, and that may be the case. And sometimes what you have to do in that instance is spend a bunch of time getting someone to a point where they will write the term sheet. But I think fundamentally, you've got to try and kind of peel the onion a little bit and go, like, what does that really mean? What are they, do they not want to set the valuation? Do they not want to have that conversation? Do they not want to have to go through the legal hassle? And if that's the case, maybe you can, use one of the platforms that's out there to kind of, almost write your own term sheet, which we're seeing more and more companies do now. Do they not have the capacity to take a board seat? And if so, can they nominate someone to do it? So I think, we see it happen all the time. And usually it is a sign of, we're not entirely, like, we're not 100% there from a conviction perspective. But I think one of the things that founders need to do is understand, in whichever market they're in, who are the people that will lead, who are the people that routinely do it, who are the people that take board seats, and then who are the funds that kind of come in alongside them, who, for a variety of reasons, maybe they're writing 25, 100K checks every year, and no one wants the responsibility of taking all of those board seats. So I think there's a bit of due diligence that companies need to do to kind of get around that. And I think the other thing is, like, don't be afraid to ask. I think do you, in your early on meetings with funds, kind of go, look, do you typically like to lead rounds? Do you like to co-invest? The other, another powerful sentence is, if a company says, hey, we really like this, we'd like to invest, we'll probably need to see a lead investor. I would say 100 times out of 100 go, is there anyone that you like to co-invest in this type of circumstance? And would you be open to making an intro? Right? Because, if they have conviction, then they'll go, oh, okay, yeah, I'll introduce you to this person. And suddenly you've got a warm intro and a potential lead. So I think you've got to kind of work the system a little bit when you hear that. But it can be a very frustrating thing if you hear it from like 10 and 15 angels and one VC, when you're kind of trying to put together a $1 million round, and you're just pulling your hair out waiting for that lead. So I think it's tough, but there are ways to kind of structure your conversations to try and get around it.
I completely agree with you. So what's one of your favorite books that has impacted you personally and one that has impacted you professionally?
I read a book a couple of years ago called I really love food. It's cooking is how I relax in the evenings, and I don't know if I'm necessarily any good at it, but I certainly enjoy doing it, and enjoying the fruits of my labor, and I certainly love going out and eating it. So I read a book a couple of years ago called The Third Plate by a guy called Dan Barber, who's a chef, has a couple of restaurants in New York and upstate, and kind of just looks at the way that we have cooked in the past, the way that we kind of industrialized farming and eating and consumption nowadays, and then kind of proposes a better way forward in terms of better way to engage with the food that we eat, a better way to eat healthily, and a more sustainable way to eat as well. And I don't necessarily agree with 100% of the things that he says in the book. I think there is a role for technology to play in there as well, but certainly in terms of kind of how I thought about the way that we eat, it was from a personal level very inspirational. And then from a business level, I really like the Checklist Manifesto. I just think it's a great book. I'm not a COO by any stretch of the imagination. I'm like the really flaky, annoying CEO type character, and so anything that helps me put a little bit of structure around my life is a good thing. And I just think the Checklist Manifesto was just a really fascinating look into how everything from surgeons and pilots and business leaders have applied a tiny bit of very simple structure to what they do and have harvested almost unbelievable rewards off the back of it.
I certainly will have to check out both. That's really cool. What's your most recent investment, or I'd imagine maybe one company from your cohort that's your most recent cohort that's consumer that you're particularly proud of? I know that I also spoke with Anna Barber at Techstars LA, and all the companies in your cohorts are like your children. But if you were to name one company in consumer that you'd like to talk about, which one would it be?
So I think to any of the companies from the most recent batches that are listening, I do love you all. No parent has an ugly child. But I think the most kind of recent publicly disclosed board seat that I took from one of the companies was a company called Banjo Robinson. So Banjo Robinson is a globe-trotting cat that travels around the world and sends letters to children to help them learn how to read and write. And so it sends letters and stickers and maps. The kids get the letters, they can write back to Banjo. The parents can then personalize the next letter that the kid gets from Banjo, so it gets into a little bit more detail about the kid's life. And the level of engagement that you're seeing. I mean, and obviously this is an era where lots and lots of children are kind of looking at screens, whether they be big or small, and getting them enthused about the idea of reading and writing is not an easy thing. But again, if we go back to that kind of the passion and the love and the consumer love that they saw, they got the highest rating ever for a consumer product on Mumsnet, which was one of the things that really kind of got me interested and engaged. They get about somewhere between 70 and 90% of the children actually write back to Banjo. They did a retail activation a couple of days ago in London where the kids came in, saw the brand for the first time, and were suddenly writing letters going, "Dear Banjo, I love you." So incredible company with incredible potential in that kind of education space and engagement space, but also more widely given where they are in that kind of 4 to 7 year old age market or age range. Real potential to build a brand that sits around that as well in a couple of different formats. So from a company perspective, I loved it. And then Kate, who's the CEO, is a total force of nature. A friend of mine sent me a message and said, "Hey, I've got this company, you should meet them. It's called Banjo Robinson. It's a cat that writes letters." And I kind of thought, "Oh, hang on a sec. Like, am I going to take this meeting?" And because he's a good friend, I said, "Okay, well, I'll do the meeting. I'll do like a 15-minute meeting." And 2.5 hours later, I had cleared a bunch of other calls and meetings and was still sitting with Kate going, "Oh my God, and what about this? And oh, we should do this." And over a 2-week period, I think we ended up sitting for, I don't know, 6 or 7 hours just talking about the brand and the company and the organization. And so we were lucky enough to have them go through the program and to invest in their round, which Collaborative and Sesame and a couple of other great angels joined in. So they're one that I'm really excited by. But certainly anyone who goes to the Techstars London program page on on techstars.com will find a lot of other companies that I'm equally excited by, but time prevents me from getting all of them out verbally.
I will certainly have to check that out. What's one company that you had the opportunity to invest in, didn't, and in retrospect, wish you did?
There was a company, and this was quite early in my kind of angel investing career, as it were. So I got introduced to this guy in Dubai who was building a service that was quite similar to Uber, so kind of ride-hailing service. Again, similar to where Uber started out in San Francisco at the kind of higher end of the market, and called Kareem. And I tested it out, and I thought there were some. I mean, it was good in that it worked and it got you around. There were some UI and some UX issues that I kind of thought needed to be addressed, but spent a bit of time with Mudassar, who was the CEO, and Magnus, who was his co-founder. And for a variety of reasons, largely probably my own stupidity, I didn't proceed with it. And they subsequently went on and sold to Uber for just north of $1 billion, and it would have been their pre-seed round that I was getting into. So, I kind of beat myself up about that every so often. But I think like anything else, you learn as much from the mistakes as you do from the successes. And I think in that instance, I thought Mudassar was a great founder. I wasn't 100% sure about the business and how it would compete against Uber and Halo, which was in the market in this part of the world at the time. And actually, my conviction should have been in this person is a great founder rather than, rather than thinking about the problems, I should have thought about the potential. Look, if you could, distill what I have to do and what I try and do on an ongoing basis into a sentence, that's pretty much it. Like it's you're really going all in on the person or the people and your belief in their ability to do something that might just change the world. And whether it's the idea they're working on then, or, and I have companies that have gone through programs or that I've invested in before where it hasn't worked out. And now they, in some cases work out of my office. I'm kind of like, okay, well, when the next, maybe that wasn't the business, maybe the next one will be. And if it's not that one, then it's the next one. And hopefully I'll have the opportunity to continue to, participate and support them and go along for the journey, because it is, I think I've said it before, it is a privilege to get to work with really smart people working on, brilliant ideas and to go on the journey with them. And to, I joke that I have to, and I do to a certain extent, have one of the best jobs in the world. And that kind of forces me to buy books all the time so that I sound smart enough when I'm talking to these founders. But it's like an ongoing educational process that never ends. And, it is just, I'm very lucky to have the opportunity to do it. So yeah, it's pretty good fun.
What's one piece of advice you have for founders of consumer companies?
I think it's talk to people. So the biggest mistake that I see companies make is assuming that their idea is so amazing that if they tell anyone else what it is, that person is immediately going to kind of steal their ball, run with it, and start the company themselves. And I think the reality is, like, everyone has their own, $100 billion idea sitting somewhere in their head. And, they're all varying degrees of good, bad, and different, and maybe even awful. So I think the more that you kind of talk to people, whether they be investors or mentors or advisors or other founders or, anyone that you can, potential customers, the better informed it's going to make you, the better it's going to be overall. I remember I met Louise, who's the CEO of a company called Yoller, which is a social planning app that gets people together fast. And I met her at South by Southwest, I think 3 or 4 years ago. And back then, the app was basically a series of post-it notes, colored post-it notes that she moved around in a pitch, which was one of the most mesmerizing things I've ever seen, because it was so well done and she was so passionate about the product. But she spent that entire event and a sequence of one subsequent to that just talking to people about social planning apps they'd used before, what had worked, what hadn't, why, and did an almost, unbelievable level of customer discovery. And I think if she hadn't done that, she would have built a lesser product. But because she did, she had a huge number of supporters. She had a huge number of people rolling in behind her. She had a huge amount of people contributing ideas and guidance and capital and more to the business. And I think you just have to put yourself out there. And sometimes it's someone who's a natural introvert. It's not the easiest thing to do, but I think you have to force yourself and have those conversations, because otherwise you'll end up building a company that's good for you, but for maybe no one else.
Yeah, no, I think that's a great point and a great piece of advice. Eamonn, thank you so much for your time. I really appreciate you coming on the show, and this has been a great conversation. Thank you.
It was an absolute pleasure. Thank you very much.
And there you have it. It was such a pleasure having Eamonn on, and I really appreciate him sharing his insights. That was a lot of fun, and I really hope you enjoyed it. If you're enjoying these episodes, if you could please leave a review on the Apple Podcast app, as that increases our exposure, that would be simply terrific. If you'd like to also follow me along behind the scenes, you can follow me at Mike Gelb and at ConsumerVC. For all episodes, please visit theconsumervc.com.